You heard the conversation there. You say it's complicated. I agree with that. It is. But what about if you're looking for the stock market to have a nice 2023? What about Bob's point that an awful lot of market watchers are looking at an earnings slowdown? It's hard for stocks to make headway when earnings aren't.
Well, for an individual stock, yes, but for the market in aggregate, there are a lot of other factors. So if we're right that we're going to have a either modest recession or just a slowdown, and the Fed is going to be less hawkish next year, not raise rates aggressively, and inflation has broken, which we think is happening, we think the market's going to focus on those positives and be able to have a PE expansion, even with earnings being a little bit lower. And we think the market is going to start to look at 2024 earnings, which are going to be in a nice recovery mode. If you go back to 2020, earnings were down very sharply, but you had a very strong market because the market looked beyond the slowdown in earnings and it looked to the recovery in 2021. We think that's going to happen in the upcoming year.
David, we've talked to a lot of advisors who have been talking about just basically tying a knot in the rope and hanging on. Are we still in a period of time where we need to be thinking about how to play defense, or is it time to start thinking about how to play offense going into 2023?
So as the market sell-off got deeper, we thought it was a good time to switch from defense to offense. We still think you want to be positioning yourself for offense. Even though the market's rallied 15% off its lows, there's still a lot of really good companies that are down 40, 50%. So we think you can look through the market, find strong businesses, strong finances, low valuations, and pick them up here. We wouldn't chase yesterday's rally, but I'm sure there's going to be some sort of negative data point in the next few weeks. The market's going to get negative again, sell off. We'd be buying into that weakness. But on a stock-by-stock basis, there are really a lot of companies that are very attractively priced here.
And it looks like you like a fair number of what we would describe as classic tech growth names: Amazon, Google, I believe it's Medtronic, and Truist Financial. Why that interesting group?
So a lot of the high-flying tech stocks have been taken out and shot this year. So we've always looked at Amazon as a great business and very richly priced. We started buying it in the last few weeks because it's selling at the low end of its price to sales and price to EBITDA. The stock's down 45%. We think from these levels, you've really limited your downside from here. And on a 12 to 18-month basis, we could see the stock 30 to 40% higher. Alphabet is a great company with great long-term prospects, yet it sells at 17.5 times next year's earnings. Whenever you've been able to find and buy premium companies at those type of prices, you do really well. In terms of medtech, Medtronic is at 14.5 times earnings. They've had some short-term glitches and bumps in the road, but we think they get their act together in the next 12 months. That stock's got 30% upside, and it's paying you a 3.5% yield while you're waiting. The last piece are the banks. We think this is going to be the sweet spot for banks. You've got higher interest rates, they've got good credit quality, and you've got a lot of loan demand, and you're buying these stocks at 9 times earnings with a 4.5% yield. Our favorite right now is Truist, U.S. Bancorp, Bank of New York, all very good companies, very attractively priced.